You know, the dollar is at a huge level. You know, that 90, let's call it 94.50 to 95.70 is absolutely massive. It's tough to kind of, we haven't even looked at indices yet today, but, you know, indices are, you know, obviously at big levels as we go into October 1st. Here's the NASDAQ, just real quick. Looking at the NASDAQ back to the September channel and the trend line from November, and the 38.2 retrace from the May low is, you know, 14.641.50. It's a big spot, right? I mean, the biggest level that we could look at, I think right now, as far as everyone's talking about, would probably be, let's see, everyone always talks about the 10-year yield, but the 30-year yield is actually the one that I follow the closest. There's reasons for that. One, it's most removed from the, you know, at least historically, from government intervention control, right? The 30-year yield is the most indicative of inflationary pressures, whereas the short end of the curve would be more indicative of you know, what the government can do. And the reason for that, of course, is, you know, what are you going to lend the government for 30 years, right? If you believe 30 years out that, you know, they're going to pay you back, that's where the inflation comes from. So we've hit off a huge level. This is the 30-year yield at, you know, 208.5 right now. I don't know. This is this could be a very scary looking chart, right? If you look back here, left shoulder, head, right shoulder. Again, 30-year yield, you're talking about an absolute rip to the upside. Just kind of imagining things happening. Hit off a huge level. So I don't know if you're out there and, you know, watching this, you know, for not just trading purposes, but, you know, kind of economic purposes, that I call it 3.1% 30-year yield is a gigantic spot to keep in mind.